So understanding China, we believe, is one of the most pertinent questions in investing. I mean, China is the world's second biggest economy, and it's a huge manufacturing economy as well, accounting for about 30% of the world's manufacturing output. So if we can understand China, then we can actually make decisions on assets outside of China, as well as to find the good investment opportunities within China as well. And we are fortunate that we've had many years, in fact, decades of experience looking at domestic China from almost 20 years ago, when people didn't even know, in some cases, where China was, to today, where everyone knows that it's a huge economy with some structural problems, perhaps. So we have the experience to understand the nuances of the risks and the opportunities that exists in the Chinese market, and how that economy, in terms as a result of policy or changes in the macro in that country, can impact assets outside of that country. And as we know, there are some issues, some structural issues, perhaps in the Chinese economy. The economy is quite mature as we speak. I mean, it's gone from a few thousand US dollars per capita in income to about $13,000 So it's growing a lot. I mean, but it is by no means as mature as the more developed economies, where incomes are 50,000, 60,000, 70,000. China is around 13,000. So the impetus for long-term growth is still there. But having said that, the easy gains of economic growth, of building more properties, building more infrastructure assets, just to propel the growth, that easy growth is well and truly over. It doesn't mean that it can't build more properties, it's just that the volume built will not keep growing every year. So that means that the country has to go through a structural adjustment. And in fact, I mean, that's what we've seen in the last few years, where the economy slowed a lot, the share market has come off a lot, and it's sort of, a deliberate attempt by the regulators to make the necessary adjustment, that's swing away from construction towards more consumption, a little bit away from exports to more domestic demand. So that's what that adjustment actually means. And that is, necessarily led to an economic slowdown in China. But longer term, we can still, see opportunities in selected categories of industries over the long term. And the valuation is very attractive because of the concerns that we all have in the country and the economy. And so all these opportunities exist despite the fact that, the country, the economy is going to grow slower in the next 5 or 10 years compared to the last 10 or 15. So the way how we deal with investing in China really is to really try to understand the risks and the nuances of that country and the companies involved. So as we said, we've been investing in the country for a long time. We are very focused on the regulatory risks environment of the economy. We try to avoid sectors which the authorities may disapprove of. And in doing so, we've avoided some of the pitfalls, during the sell-off in the last 2 years. And instead, we focus on sectors which are, enjoys regulatory tailwinds, the sectors which actually the regulators would want to encourage. And some sectors which the regulators like are domestic consumption-related sectors, domestic brands, domestic industrial companies climbing the technology ladder, displacing some of the imported products, in areas of healthcare and also life insurance. So these are the broad categories which we tend to focus a lot of efforts in trying to identify basically the next champion company out of this huge economy. Granted, it's going to slow, but these sectors actually will continue to grow. And we can access these opportunities at very attractive valuations. So an assessment and understanding of the regulatory risk, we think, is essential in investing in China. As well as that, to make our life easier, we focus on the sectors which enjoys regulatory tailwinds instead of headwinds. And within that, we tend to want to focus on the leaders the strong companies which will continue or which will get stronger in years to come. Given that the Chinese equity sector, tends to come in and out of favor. So we are not, we don't hesitate to actually adjust our exposure. Depends on whether we can see, good upside opportunities available. And on the other side, if the valuation goes up to a high valuation or high level, we would not hesitate to actually reduce our exposure. So we have a, reasonably flexible approach to investing in China. For example, end of last year, we were initially a little bit, quite light on the exposure in that region of the world. But when we worked out quite early, actually, that there was a drastic change in the COVID policy, the reopening, and also the regulatory policy towards private enterprises, towards internet companies, more relaxation of monetary policies, we actually increased our exposure quite quickly to try to capitalize on the upside, given the valuation was cheap, and it was quite an opportunistic time to actually add to exposure. So we are always looking at the environment, look at the regulatory environment, we look at the macro environment to try to finesse our exposure to China. But the underlying idea is that, well, the country is slowing, perhaps structurally for various reasons, but there will be, and there is still going to be champions that continues to grow, and we can access them at the right time at very attractive valuations.